take it away.
Thank you very much, Hannah. And we have 3 papers on a very similar topic, which is automated market makers. And I realized that the last session had 2 other papers on this topic as well. So I hope there's not too much repetition in this brief introduction. So these are central to the area of DeFi, or decentralized finance. And they're really quite different from the kinds of asset markets that most of us are familiar with. You don't have an order book. Instead, you have something called a liquidity pool. And absolutely anybody can contribute crypto assets to these pools, which are then going to be lent out to other people. The prices of the assets in the pool are set by algorithm, which is essentially written to respond to supply and demand with immediate settlement of the trades. And this is, again, very different than a traditional order book market, where there's essentially a market clearing auction that is subject to choices made by the market participants. The rewards are equally shared. It's rather socialist in that the liquidity pool is mutualized. And to me, the most important facet of all this is that nobody's in charge, in a sense that you can't really reach a central actor by way of regulation and get them to enforce compliance, to collect data about the customers and so forth. The decentralization goes very much against the wishes of the market regulators, but I think is very attractive to people who don't want to identify themselves or pay taxes or engage in many other kinds of compliance that might be inconvenient or costly. So when you look at these AMMs, to me, they are very similar to the vision that Vitalik set out for Ethereum. That they really represent the fruition or the realization of the original vision of a decentralized type of finance that is not mediated by anybody. And in doing a little research, I was surprised to learn that these have been around actually for decades. There's about a 30-year history of these. The very first one apparently was launched by JP Morgan, but they really have not been so automated or decentralized. And I think even the ones that you see today have different degrees of human oversight or intervention that allows you to differentiate them to some extent. But they are growing extremely fast. I think this is the main reason that we should be studying them as academics. And they are hugely controversial, which is a polite way of saying that the regulators absolutely hate this technology, that they really don't know how to engage with it or what to do about it. So these would be the research questions that I'm interested in, and I think many of the papers have touched on. So first and foremost, there's a pricing curve, and how good is this curve in terms of clearing the market and attracting people and generating rates of return and satisfying both sides of a transaction? I think this is obviously an area where the research is likely to be ongoing for some time, but the papers today have something to say about this for sure. Another really interesting issue is the exploitation of vulnerabilities in the underlying code of these platforms. And I've included a takedown, very clinical dissection of, I'm not sure hack is the right word, but an attack or an exploit against the Uniswap platform that took place, I think, about a year ago. But you read about these almost by the week, and that these are platforms run by code, but the code is imperfect, and the code has left itself open to a whole new class of intrusions that are variously called flash attacks or oracle attacks, things that people really didn't imagine could go wrong, but ultimately are costly to the market participants and would also tend to undermine confidence in the technology as a whole. So I've come to the conclusion that this is still very much a work in progress. It's an immature technology, but nevertheless, I'm impressed by what it's been able to achieve. But I think the big question hanging over this area is what the future of regulation might be. And I've reproduced on the left a headline. I think this was taken from a feature story on CoinDesk, where they say DeFi is like nothing the regulators have seen before. And without middlemen, the SEC is sort of on its own and has to rethink its approach. If regulation comes in, the collection of taxes, the compliance, of know your customer disclosure and so forth, is going to throw a huge blanket over this whole area. And if and when that happens, I think it would very much change the demand for the service and probably the supply side as well. But so far, that really hasn't occurred, and if and when it might is anybody's guess. But I think anybody participating in this area has to worry about the eventual entrance of regulators, not just in the US, but all over the world. So with that introduction, let me go back to our list of papers. Many of the authors are extremely well known, I think, to everyone in the audience. These are some of the top people in the crypto area. And the first paper is by Alfred Lahar and Christine Parler, who are the author of a very successful recent paper on the Bitcoin blockchain and now diversifying into another crypto area of decentralized exchanges. So Alfred is standing by, and we will have 15 minutes for each presentation. So Alfred, the floor is yours.
Thank you so much.
Let me take down the screen. Oh, Hannah has already done this. Okay, go ahead.
Okay, perfect. So thank you so much for having us today. And this is joint work with Christine Parler. So in most of the modern exchanges, we have some kind of variant of an open electronic limit order book. And in finance, we tend to think that this is the best way and the most efficient way to provide liquidity. And the key assumption that's underlying this is that these market makers are perfectly competitive and get zero profit. But then on the other hand, we have a lot of investments into high frequency trading technology. Co-location is important, where people put the computers right next to the exchange computer. And it seems like these liquidity providers, sorry, that's a typo, are trying to carve out some kind of competitive niche and try to get some money out of this. So we want to examine a new form of liquidity provision, that is these liquidity pools, as they are present in many of the DeFi exchanges. So what are our main findings? So our main findings are that these liquidity pools can actually dominate limit order markets, especially when there's not many informed traders, when there's a lot of uninformed volume, when prices do not move that much, and when the incentives to invest in this high frequency trading technology are very high. We then take our model to the data and document that these liquidity pools actually track limit order market prices pretty well. We show that in these liquidity pools compared to limit order markets, we have lower price impact and can have lower variation in price impact. So I will not go into the details of the model, but there's a detailed model in the paper. Let me just show you a little bit how we approach this. So there's an asset that can either stay at the same price, in which case a liquidity trader arrives and trades an exogenous amount of units, or the price could go up and down, in which case an informed trader arrives at the market and takes advantage of this information that she knows whether the price has gone up or down, and trades on that information. Everybody is risk neutral in our model. And let me start by highlighting a little bit about how we think of the limit order market. So we start with the standard assumption in most microstructure models that there is a competitive liquidity providers, and they make some money from selling or buying from these liquidity traders. They collect a bid-ask spread, but they lose from trading with the informed trader or the arbitrageur if such a price innovation arises. So on average, they break even. Now we add to that kind of standard model that these liquidity providers can invest in a technology that allows them to extract a little bit of extra money. And we think about that as some kind of high frequency trading technology, or they have some technology to learn if an institutional trader is placing a large order and then they can withdraw liquidity, or they somehow learn information faster than others. And if they do, they get some kind of competitive advantage, which we assume, just to make life a little bit easier, that they are a monopolist liquidity provider. And then, of course, they will charge a high spread. So this technology is wasteful and costly, and does not provide a lot of value. So we then kind of take this setting and compare it to a Uniswap setting. So I'm going to free ride a little bit on the previous talks and just say that this is a huge market and there is tens of thousands of liquidity pools out there. Everybody can be a liquidity provider, and pricing in these pools follows this bonding curve model. So if we assume that we are at this red part here where there's amount of ETH in that pool, for example, and some kind of token, the way this works is that if somebody wants to sell an amount of tokens to that pool, the token balance moves from T0 to T1 and goes up. And how much ETH do you get in return? Well, we can solve that graphically here by looking at the y-axis and looking at the difference in the ETH amount, so that the point of where the pool is before the trade and after the trade is exactly on the same bonding curve. So how do we think about our agents in the model interacting in this kind of environment? So we have these liquidity providers who provide this inventory of this liquidity pool, and they are mostly passive, and they collect some kind of fee per trade and are looking at earning this fee revenue. So what comes if a liquidity trader arrives and there is no change in the true price of the token? What happens, let me show that graphically, is that the liquidity trader arrives and pushes, say, the price from E0, T0 to E1, T1. And then, but this is not the true fundamental price. And so an arbitrageur comes along and pushes the price right back to the fundamental value by doing pretty much the opposite trade. So for the liquidity providers, no harm has been done because they end up exactly where they started, but it was actually beneficial for them because they collect now 2 times the trading fee. So for the liquidity providers, this was a beneficial event. Now, the part where liquidity providers lose out is if there was a change in the true price. So if there's a change in the true price and the true price of the token is now E1, T1, then the liquidity pool, of course, quotes a stale price because the liquidity pool is just a computer program, doesn't know what's happening in the outside world. So it's quoting a stale price, and the arbitrageur will take advantage of this mispricing. The pool gets picked off and the liquidity providers lose out in this case. So how can we think about this setting? And the first thing we solve for is the optimal size of the pool. So these liquidity providers are willing to provide liquidity in equilibrium as long as the fee revenue they get from collecting these trading fees equals the losses they have from being picked off from the pool quoting stale prices. So this will determine some kind of optimal pool size that these liquidity pools have. It's noteworthy that the pool size determines the price impact. So the curvature of this bonding curve we might think of is determined by the size of the pool. So if the pool size goes down, the price impact goes up, and that makes it less attractive for an arbitrageur to pick off the pool. And so we have these balancing forces that give us some optimal size for this pool. So we show that under some conditions, these liquidity pools can be better than the limit order markets for an uninformed trader. And in the limit order market, you have this, again, this incentive to invest in some kind of high-speed trading technology that gives you some kind of competitive edge. Versus in liquidity pools, these losses get mutualized. So you don't really have an incentive to withdraw liquidity at a high frequency in these pools. And also a difference is that I'm, for example, a liquidity provider in Uniswap. It's fairly easy. I don't have to invest a lot and don't have to monitor my liquidity provision, versus I could not be a liquidity provider on the New York Stock Exchange because I don't have the technology to do that. So we could potentially attract a lot of liquidity providers with this. So in the model, we derive some conditions when these liquidity traders prefer pools over limit order markets. We then look at the data. So we look at Uniswap V1 and V2 pools. So we have about 36,000 individual liquidity pools that we look at, and 47 million transactions from the start of Uniswap in 2018 until May 21. So most of those are trades. There is a few, about 1 million liquidity injections, about 600,000 withdrawals of liquidity, and about 45 million trades. So the first question that we want to address in the data is whether this equilibrium pool size kind of coincides with the predictions of our model. And we find that the pool size decreases in volatility, and we take volatility as this kind of a measure for how much can the price potentially change if there is an information event that arises. We then want to identify uninformed trading volume. And of course, this is harder to get. We say we do 3 proxies for that. So the first one is that we just take general volume, because we think that there is only a certain amount of trading that you can have based on new information that arrives, and any extra trading on top of that should be uninformed. So, and if we use that, indeed, the trading that the pool size increases in trading volume. We use a similar logic to look for the number of trades, because in these liquidity pools, there's not necessarily an incentive to split orders. So any number of orders that comes beyond the informed trades must be uninformed trading. And we see again that the pool size increases in the number of trades. The last thing we are looking for is reversals. So this is the very specific pattern where somebody comes in and trades in one direction and moves the price, and then immediately afterwards comes an arbitrageur and kind of pushes the price back. So this is what we have in mind with these liquidity traders, and we can observe that in the data when somebody trades and then somebody comes along and pretty much pushes the price back to where it was before in the next trade for that liquidity pool. And we find this is probably our best proxy for uninformed volume. And again, we can confirm that the pool size is increasing in these reversals. What we also show is that a liquidity provision is pretty stable. So only a small fraction of the observations in our sample are liquidity withdrawals, and these do not really happen at a very high frequency. So we only find 1,800 events where the same address added and withdrew liquidity within 50 blocks, which is pretty wide window. And the median size of these liquidity additions and withdrawals is $146. So we think this is mostly like people, hey, let's try this out. What happens if I inject liquidity and then I withdraw it again? Do I get my tokens back? Does this work? So kind of more exploratory in nature. So we only have 18 observations out of the millions in our sample where somebody deposits and withdraws liquidity over $1,000 within 5 blocks. So that's practically a pretty low frequency event. So in this graph, I show you the liquidity provision around a crisis event. So this was on May 19th, 21. So if prices relative to US dollars dropped by 41%, which is about twice as much as in the October 87 stock market crash. So in the orange area, you see the price of ETH. And this is a minute by minute, block by block data that we have here. And on the blue line, you see the total liquidity withdrawals from the main ETH US dollar stablecoin pools. And what is noteworthy is that, first of all, only a total of 17% of the liquidity was withdrawn throughout this entire period, which was a huge market crash. So in the stock market, if there is such a crisis situation, we see that liquidity evaporates very quickly. And the second thing we see is that liquidity was withdrawn pretty much after the price of ETH bounced back quite a bit. So we see that these liquidity pools actually are very stable to provide liquidity in a crisis situation. And one way to think about this is that there is a lot of trading in such a crisis situation. Then that also means that there's a lot of fee that's revenue that's being collected. So we then look at how does this compare, these pools compare to Binance. And
Alfred, I'm going to need to ask you to wrap up.
Okay.
We're right at the end of your time.
Okay, sorry. Yeah, and so we do see that these prices match pretty much well. So we want to say that we presented some evidence that this new model of liquidity provision actually works pretty well. What I could not show you, what's in the paper as well, is that these liquidity pools have a lower price impact than a limit order market, that's a Binance market, and also have lower variation in price impact. And therefore, we think that this can be quite an attractive venue to provide liquidity compared to the traditional markets. That's it.
Thank you very much. And we're going to defer questions on all the papers until the end in the interest of staying on schedule. And our next presentation will be by Daniel Engel, who has co-authored with Maurice Herlihy, both of Brown University. Their topic is loss and slippage in networks of automated market makers. Daniel, you have the screen share and you can take it away.
All right, thanks. All right, hi. So yeah, I'm Daniel Engel, PhD student at Brown University, advised by Maurice Herlihy. So this paper, Loss and Slippage in Networks of Automated Market Makers, it's kind of a formal look at a couple of ways that we can evaluate the choice of an AMM function, a curve or a surface. It's a way, we propose a series of metrics for being able to evaluate them for liquidity providers and traders. So the first few slides, I think we all know what an automated market maker is, but just this is the kind of way I'll be thinking about it in this talk. Really, for this paper, an AMM is a choice of a curve, and the state of the curve corresponds to the reserves that are currently held in the contract, and the curve, whether you describe it with a constraint function or an explicit function, it tells you the valid states that can be transitioned to by traders. This diagram neglects like fees, which are actually charged in actually charged in practice, but this is the basic idea. So for automated market makers, you have these curves, and there are two agents that interact with them. You have the liquidity providers, who are allowed to deposit reserves, spare change of assets they might own. So when that happens, what they do is, if the state was initially this x naught f of x naught, a deposit by a liquidity provider increases the reserves by some delta x if they deposit some delta x, and delta y if they increase the reserves by that amount of any other asset. And the effect of that is it just corresponds to a translation of the curve. So that's kind of what liquidity providers can do to change the curve. They're just translating your choice of curve around. And on the other hand, traders, what they do is initially when they arrive to the curve, it's in a particular state. And what they will do is they'll deposit some amount of their asset, they lose that asset, and they get the difference in the height of the functions in exchange. So that's pretty much kind of how the two interactions work in a simplified way. So this, the focus of this work is, so there's a lot of choices in these curves. In previous work, we talk about some axioms they need to satisfy. They essentially need to be strictly convex kind of curves that are, they asymptotically go to the corresponding axes in each direction. But there's a lot of choices, and we want to have a way to evaluate what does it mean for an AMM to be good and for who, and what does it mean to talk about optimal AMMs, and kind of what are the most natural constraints on the design space of all AMMs. So we really want a way to measure the quality of AMM, one for traders and also for liquidity providers. So that's kind of what we'll be going through next. The first idea that we need to be able to talk about these different notions of slippage and loss is this thing we introduced in previous work called a stable point map. So the idea of it is if the market, so one of the main advertisements of AMMs is that when the market changes, the arbitrageurs will come along and push the AMM to a state that corresponds to that market valuation. So we formally, in previous work, defined this idea of a stable point map. So for any market valuation, we show that there's this map, if your AMM satisfies our axioms, that maps you from the space of all valuations to the actual surface of the AMM. And this is like a continuous function. It's pretty well behaved, and it's a really useful object to be able to prove properties of AMMs and talk about measures of AMMs, like the goodness of an AMM for traders or liquidity providers. So intuitively, the way you think about it is it maps a valuation like an exchange rate to the state where arbitrageurs would push the AMM via trade to maximize their profit. That's kind of how it's defined. And so the first kind of measure we introduced in our paper is this idea of capitalization. So this is saying if an arbitrager thinks the current valuation today is some V, they'll push it to phi of V, this stable point map. They'll push it to the state on the AMM that has that state, and the valuation of that state, you'll get back a number, and that's what the capitalization is. It's sort of the value of the holdings at that point in time according to today's market valuation of V. So this is just an example of what these kind of capitalization curves look like. So for the constant product Uniswap curve, you get this symmetric blue curve. For something that's like a non-symmetric kind of variation on the Uniswap curve, you get this slightly asymmetric orange curve. And the main result we have about these capitalization functions, and this is, for any AMM, you can compute this capitalization function exists. The capitalization function is maximized at the fixed point of your choice of function when you evaluate it with a stable point map. And so really what this means is that if you have your, the fixed point corresponds to when all the coordinates are the same. So the value of the holdings of the AMM are maximized when all the coordinates are the same, and then you evaluate that on the constraint function that corresponds to the point. So you intersect the vector with all the same elements onto the curve, and that's the corresponding point. And it's interesting because what that means is that the way how you choose your AMM function is a reflection of what you think maybe the most likely market valuation is. So wherever this is maximized is kind of the point where you expect the exchange rate to linger around on in the market. So that's kind of the first measure we introduce, and we'll use it to define loss and slippage. The next metric is kind of what's commonly talked about as like liquidity providers take on impermanent loss is sometimes what it's called when the market changes. So we formalize this and we call it divergence loss. It's really like if the liquidity provider thinks that the market today is the true market rate is V, and then it shifts kind of under their feet to V prime, then if they really can't do much because arbitrageurs are going to change the AMM quickly, and this divergence loss is a measure of how much they lose out because they didn't react quickly enough to the change in the market. So it essentially says, okay, the state gets pushed to because of the market change to V prime, an arbitrager pushes the AMM, moves the state around to the stable state for that new valuation. And because the liquidity providers didn't do that, there's a loss. It's inherent. And it's always going to be, this divergence loss is always, it's always going to be non-negative for any distinct market valuation. So it's kind of inherent to AMMs unless you change the way that people interact or you charge fees. So the next result we have is that, even for fixed size trades, you can always find a way that traders will interact with the AMM such that actually divergence loss, it can't be removed, but it's actually unbounded. So you just can't get rid of it. So there's always going to be some harm to the liquidity providers. regardless of how you choose your AMM. The other, on the flip side, so that's how your design choice can hurt liquidity providers. On the flip side, there's how it can hurt traders. The thing that traders really want is they want the states that they trade at to be roughly linear, and that's never going to be the case because of the constraints on the AMMs. They have to be nonlinear curves. So kind of the difference between the true exchange rate, where the current state is, and how much their trade actually gives them. If you weight that with the current market valuation, you get this idea we introduced called linear slippage. So it's kind of like, well, they can't, they're never going to get the ideal trade, but maybe if you flatten the curve, they get something closer to the ideal trade. And this is a measure of how much the trade will deviate for a fixed trade size. And similarly, there's another measure we introduced, which is angular slippage, which is just how much due to the curvature of the curve, the market rate changes, or the AMM thinks the market rate changes based on a fixed trade size. And the main results we have there is we have an analogous result for traders. So even for bounded size trades, there's always going to be a state where you can't entirely remove the linear slippage. So even if you fix a trade size, say we can't allow trades larger than this size, because of the way that AMMs are, you could do a trade here and maybe the linear slippage is quite low, but if you do it farther up, lower on the x-axis, you're going to get really bad linear slippage for traders. So it's something you can't really, it's always going to be there, and you might just want to try to, you can't get rid of it, so you can try to think of ways that you might try to mitigate it by changing the rules of how people interact with AMMs, or maybe making assumptions about where the market might, the valuations the market might go. Also, and there's the result for angular slippage we have is that for any angular slippage, which tells you how drastically the market rate will change according to the AMM, there's always going to be a trade that's going to have that angular slippage. So regardless of how you choose it, there could always be some state where if a trader ends up doing a trade in that state, it's going to swing the opinion of the AMM to think that the market changed that by any amount. So finally, we introduced this other notion which says, okay, it seems like divergence loss, or what's often called impermanent loss, is kind of inherent to the design of AMMs. And there's also this linear slippage. So maybe one reasonable metric is to somehow try to define if you want to evaluate an AMM, you use this thing called load, which is some combination. We use the product of the two cost functions to sort of evaluate the quality of one. In this way, it's like maybe you make some compromise. You can't get rid of divergence loss, and you can't get rid of slippage. So you make some compromise for both agents, both types of agents. So just in summary, both of these, the AMM loss and slippage, there are different measures about how the AMM design will affect different parties. The next kind of question that we talked about in our paper is how do local AMM changes affect networks of AMMs? So far, we're just saying how do these different measures apply to just the design of a single AMM, but oftentimes we're interested in how traders might interact with multiple AMMs. So one of the ways that traders can interact with multiple AMMs that we've introduced in a previous paper was via sequential composition. So the idea is that a trader they do a trade with one AMM and they route the payment from that trade into another AMM. And the question we have is, well, how do these measures interact with that kind of behavior? We have a result that says if you do a trade like this, from the standpoint of the trader, it's indistinguishable from trading from just a single AMM. So this kind of composition, they're sort of closed under this kind of composition. So the result we have in the paper says that the divergence loss and the linear slippage, there are linear combinations when you evaluate them on the composition of the individual loss and linear slippages of the individual AMMs. And the angular slippage is it's kind of intuitive. I mean, it's because the composition of two AMMs is again an AMM, it's just this angular slippage of the resulting composed AMM. And an important property is that the load of the composed AMM is strictly larger than the loads of the original. So a way to think about that is, if you're a trader and you're considering doing this kind of chaining of trades, then if the more it kind of it disincentivizes you from trading with multiple AMMs, because you're going to end up incurring a bigger loss potentially than if you were to just stick with one. So it has implications, we think, for the design of how multiple AMMs would interact with each other, and how you make that decision on how you choose which AMMs you should put in a network together with others. In a similar way, there's another type of composition we've defined previously, where instead of if a trader has, maybe there are multiple AMMs that manage the same underlying assets, the trader might choose some amount of purple coin to send to one AMM and the remaining amount to another AMM, and that defines another kind of composition operator, which we call a parallel composition. The result is you get back something that looks exactly like an AMM. Again, it's like closed under this operation. So when you evaluate the loss and the linear slippage on the resulting composed AMM, it's additive. So it has this kind of simple algebraic property, and the angular slippage is just the same on all of the resulting AMMs. And you get a similar result for this kind of composition, that the load is strictly larger on the composed AMM. So yeah, basically, to summarize all of this, there's many choices of these AMM functions. Loss, slippage, and loaders, we think, are the most kind of natural ways, specifically linear slippage, to measure the quality of an AMM, depending on, if you're a liquidity provider or a trader. And they're also used. We also can say a little bit about how these measures are affected under composition when traders route their payments through many AMMs. So I just kind of want to end this with some other kind of ongoing work that we're looking at now, which is this that tries to mitigate some of these issues. So this is an idea that kind of comes from Uniswap v3, which we call pseudo arbitrage, which is, when we're thinking about this in this work, we're saying that you're not allowed to, the curve must still satisfy all our AMM axioms. So you can't like do anything like translate the curve out of the first quadrant or anything like this. It's not allowed, because then that corresponds to states where you have negative reserves, and that doesn't really make a lot of sense. But if you do allow yourself to do this, if your current state is here, and then the corresponding stable point for evaluation V, and the market changes to some V prime, you're going to have, like I mentioned earlier, there's going to be inherent divergence loss that happens as a result of arbitrageurs pushing the state if you use the traditional rules. Alternatively, you could you could change the curve that goes to the AMM, you just via a translation, and you say, okay, I'm willing to actually prevent these set of reserves from being accessible, but I'm actually preventing divergence losses from happening for the liquidity providers. So again, like we want to kind of understand, like if you slightly change the rules and allow this kind of behavior, what can we say about the properties of the resulting AMM if you allow these kinds of shifts to happen? And another thing we want to look at is,
Engel, I'm gonna have to ask you to wrap up. You're already
Okay.
over time, and we have another speaker.
Okay. The last thing is that we basically want to look at, if you have a distribution over future valuations, some market model, then how could you talk about optimal AMMs with respect to that model using our metrics? Yep, and I think I can basically finish up there. Yeah, we are interested in dynamically modifying AMMs over time, the curves, and reasoning about how that affects the composition of them. And that's pretty much it.
Thank you very much.
Yeah.
So we'll come back later for questions, but the third presentation now will be by our colleague from Colombia, Agostino Caponi. And Daniel, please take down the screen share. Yeah. So Agostino, the floor is yours.
Yeah. Thank you, David, for the introduction. Can you see the screen?
Looks good. Yeah.
Okay, perfect. Okay, so thanks for staying till the end. I know there's been quite a lot of fatigue being the last presentation. And I would like to speak about this work, which is joined with Ruiz Eja, who is a star graduate student at Columbia, so a brilliant student. And the work is about the adoption of blockchain-based decentralized exchanges. And let me start, and I will give a brief introduction because the discussion of AMM and decentralized exchange has already been mentioned several times during in today's talk. Like Andreas did a very good job already, and other presenters also. So I want to mention that basically the whole point of decentralized exchange, as also David said in his introductory remark, is to pool liquidity. So liquidity providers are participating by sharing tokens on this platform. And then we have liquidity demanders, who are investors who would like to swap tokens. So they would like to get, say, an Ethereum token for a Bitcoin token. And they can do that in a completely decentralized way. What they do is, they basically face a smart contract, and before they can swap, there must be some investors, like liquidity providers who are willing to provide liquidity. So what these liquidity providers do, they are supposed to provide liquidity according to like the ratio of the tokens that is currently available in the pool. So the state of the pool determines the rate at which you can deposit. For example, in this case, where we have 100 token A and 10 token B, if you choose to deposit 10 token A, you have to deposit 1 token B, because the ratio between token A and token B is 100 to 10. And as a result of depositing, you become like a shareholder of this pool, and you get pool tokens. So the pool token that you get is in proportion to the ones that you have deposited. So what incentivized liquidity providers to deposit essentially is that they earn the fee. So every time an investor wants to trade and he wants to deposit, swap, let's say, token A for token B, he pays a fee which is proportional to the amount of token A that is depositing in the pool. And this fee is like currently very low, like around 0.03%. And it's essentially the incentive that is given to the liquidity providers by the investors. So how does the automated market maker work? Essentially, as it has already been mentioned, and Andrea said a similar figure in his presentation. Essentially, what we want to do is we want to make sure that before and after the trade, the value of a specific function, which is exogenously given by the AMM, remains the same. So, for example, in this case, if we have 10 token A and 10 token B, and an investor comes and he wants to swap 5 token A for some token B, then the constraint is that the new amount of token A, which is 15, times the new amount of token B, which is smaller than 10 because you are taking token B out, has to remain constant. As a result, you will not be able to exchange 1 for 1 in this case, but you will pay a cost. You pay a cost for this execution, which is basically the slippage. The fact that you are trading is imposing a cost, and you will not be able to get the same amount of token B as the amount of token A that you are depositing. So what are the 3 main characteristics of the AMM that are essentially crucial for us to derive the results and show what is the flow, I think, in the current design? So one problem is the blockchain settlement. And what we know is that once the transaction is included in the blockchain, it's instantaneously executed. So prior to the execution, you retain control of the tokens, and it's only at the time where you are selected for execution that the tokens are basically given or deposited in the pool. And liquidity pooling basically is a very democratic, I mean, it's essentially a sharing mechanism in the sense that all liquidity providers, everybody who is a token holder and he wants to deposit, he can do that. And by depositing, he becomes a shareholder of this pool. So they are all like sharing some of the profits that are made in the AMM. And these profits are essentially the fees that are earned from the investors who trade. And the pricing function is pre-coded, so there is no real matching. Everything is happening. You are essentially transacting with this smart contract. You don't have to be paired as you do in a limit order book. And users can gain access to liquidity immediately, instantaneously. So now, what this paper does is basically it shows that these characteristics of the AMM allow arbitrageurs to extract arbitrage rent from the liquidity providers. So the reason why we have this extraction of arbitrage rent is because of the processing mechanism of blockchain, where you have to pay a fee or an execution fee in order to be selected for execution, and because of the adverse selection costs that are shared by all the liquidity providers in the AMM because of this liquidity pooling features. So as a result, so this is the problem. And the consequence of this problem of the arbitrage trend is that liquidity provision becomes more expensive, and it also imposes externalities on other users of the blockchain because of the surge in the gas fees. How to fix the problem? One possibility is basically to design a pricing function which reduces this impact of the arbitrage trend on the liquidity provision, and as a result improves the welfare of all the participants in the ecosystem. So this part, the third part, is in the paper. I don't think I will have time to discuss it in the presentation, but I welcome any question and any further follow-up. So let me go and discuss quickly the model. So the model is like fairly simple. We have three periods. We have three agents in this model. We have liquidity providers, two arbitrageurs who are competing for execution, and there are investors who trade for private reasons. And we have two tokens that are traded, token A and B. So this is like placeholder for any pair of tokens that are traded by the AMM. It could be Ethereum for Bitcoin and many others. And there is not asymmetric information. Everything is publicly known. So we know the fundamental price of the tokens A and B at all times. Here is the timeline. In the first stage, liquidity providers have to decide whether or not to deposit, and if they choose to do so, how much to deposit of token A and token B. In period 2, there will be either a token price shock, so the fundamental price of the token will change, or there will be an arrival of investors who could be either an investor who extract benefit from A token or extract benefit from B tokens. And in period 3, there will be arbitrage, and there will be two kinds of arbitrage which are possible. One is the so-called stale price arbitrage, and the other one is the reverse trade arbitrage. And I will go in detail on these two types of arbitrage as we proceed. So the pricing function that we assume, we don't want to stick with, we don't want to basically only work with the constant product function, which is the one used by Uniswap, but we want to be broader in general. And in fact, what we impose is the constraint that this function is convex and twice continuously differentiable. So basically, if we look at all the AMMs, not just Uniswap and SushiSwap, you see that all of them are implementing a function which is of the convex form and like differentiable and so on. And basically, the framework that we develop encapsulates all these AMMs that we have seen up to now. And the constraint that this function has to satisfy is that, as I mentioned before, if you evaluate the function at current reserve of token A and B, this has to be the same as the function evaluated at the new reserves of token A and the new reserves of token B. So if you deposit delta A token A and you take out delta B token B, then you want this function to be exactly the same. So if you now you apply the implicit function theorem to this constraint, you see immediately that you get the marginal exchange rate. So the marginal exchange rate tells you what's the amount of token B that you get as you deposit token A. And as the number of tokens that you're depositing becomes smaller and smaller, then the number of token B that you get also becomes smaller and smaller. And in the limit, it converges to this ratio between the derivative of the function at x and the derivative of the function at y, computed at the current state of the pool, where the current state of the pool is captured by the amount of token A and B that we have. So now let's go through the model and see what liquidity providers do. So the liquidity providers, there are n of them, and each of them is initially endowed with a positive amount of token A and B, which we denote by E. So E sub AI is the number of token A that liquidity provider I has, and E sub BI is the number of token B that liquidity provider I has. So liquidity provider are essentially deciding what's the amount of tokens that they want to deposit, which we denote by Y, and what's the amount of tokens that they want to keep out of the AMM, which is X. So if they deposit, they will get a profit at the end, and this profit, the profit that they get depends on what is the price, what is the fundamental price of the token at period 3. If they don't deposit, they will also get a profit, which is essentially given by the value of their holdings at the end of period 3, measured again against the fundamental value. But of course, if they choose to deposit, they also have to bear the consequences of doing so, which is basically being subject to possible exploitable arbitrage opportunities. The constraint that they face is basically that when deposit happens at the very beginning, they have to deposit at an exchange rate, which is given by the ratio between the fundamental price at time 1 of token A and B. That basically the budget constraints that they can only deposit what they have, which is the initial endowment, and of course what they deposit and what they hold has to be positive. So now, after they solve this period, then the problem at time 2, we will have to see two possible events. Either there is a shock to either token A or B, or there is an investor who arrives. And what we assume is that A and B.
Agostino, can I stop you for a moment? There's a clarifying question in the chat. What
Yeah.
is what is WI?
Yeah, sorry. Thank you for asking this question. And I forgot to mention. So WI is the share of the pool of the liquidity provider I. And that's a very important point. So for example, if you have two liquidity providers, then we have WI is equal to 1/2 because each of them holds one share of the pool in case they hold an equal share. Okay. So this is like the share of the pool share, the pool tokens that they have when they deposit. Does it answer the question? Okay, thank you. And please interrupt me anytime if there are other questions. So as I mentioned, there might be price change of A and B tokens that is caused by idiosyncratic shocks, and beta is the size of the price change. Kappa A and kappa B is the size of the shock. So if we have a positive shocks, and the probability at which this shock arrives is larger for token A than for token B without loss of any generality. And we can also have that there might be an investor who comes, and this investor can be type A or type B. And type A and type B is basically a reduced form model for the private utility that the investor are getting. So if the investor is type A, then he will get a utility which is 1 plus alpha times the price of the token A at time 1. If he uses this token on the platform. For example, if this investor wants Ethereum token because he wants to run DeFi applications, then his benefit alpha is basically captured by this parameter. So now what happens in the third period, we have to look at potential arbitrage opportunities that can arise. Let's look at this figure and let me explain what are the two types of arbitrage that we can have. So importantly, there are two exchange rates to keep in mind. One is the spot exchange rate, which is the exchange rate which is entirely decided by the state of the pool. So this only depends on the amount of token A and token B that we have in the pool. And then we have the fair exchange rate, which is the exchange rate which is the fundamental exchange rate. This is not related to the AMM, but it's just the price of token A and the price of token B that we have like outside of the AMM. So now suppose that there is a shock to the fundamentals. For example, token A becomes more valuable than token B. Okay, inside the AMM, nothing has happened, right? Because the idea is that within the AMM, like the price entirely depends on the reserves of token A and token B that we have in the pool. So that what this means is that you have a potential arbitrage opportunity that can be exploited, because if token A is becoming more valuable than token B outside of the AMM, within the AMM, you could basically trade token B for token A at a cheaper price. And therefore, you will be able to exploit this opportunity at the expenses of the liquidity providers. If the liquidity providers are not able to withdraw their tokens before, they will basically be exploited. The other type of arbitrage is what we call the reverse trade arbitrage. Suppose that an investor comes, for example, and he trades 5 token A per some token B. So in this case, we see that we go from 10 token A in the pool to 15 token A in the pool. And there has been some slippage due to the execution cost of this action. So now what happens is that if an arbitrager comes and he wants to do reverse trade, he can do that. He could swap back token B for token A, and he will profit from that. He will basically be able to take the spread out of this trade, because the previous trade has resulted in arbitrage opportunity that can be earned. And the key point is whether or not these two arbitrage can be really exploited, because as we know, the key friction here is the fact that you need to go through the blockchain, and to go through the blockchain, you need to be selected for execution. So this entirely depends on how much you are willing to pay in terms of execution fee. Now, first of all, like the profit of the arbitrager is exactly equal to the loss of liquidity providers. So there is a wealth transfer from liquidity providers to arbitrageurs. So now if we think about the arbitrager, their first execution has a value, let's say pi. So that's how much they would earn from this arbitrage. Now, both arbitrageurs are willing, if there are two arbitrageurs, they're willing to bid up to pi, because they're willing to bid up to the rent that they can extract from the liquidity providers. On the other hand, if we think about the liquidity providers, like there are like many of them, right? Each of them is only a share of the pool. So they are essentially sharing the adverse selection cost between them. And each of them is only willing to bid at most this WI times pi, where WI is more than 1, because that's essentially their share of the pool. So they are sharing this adverse selection cost. So that means that if we already have two arbitrageurs, then the liquidity providers have no way to bid higher than pi, because basically it's not incentive compatible for them to do so. And this is exactly the reason why the arbitrageurs can extract their rent, because they're willing to bid more than them. And just to
Agostino, we're at the end of your time, and I see that you have 62 more slides.
No, it's not 62.
You need to wrap up, I'm afraid.
I will wrap up. I think I will need a couple of 2 minutes and I'm done. So the 81 are like backup slides, no worry. So, I mean, I just want to mention that like there is an analogy to the sniping risk that we have in the limit order book, because I mean, in both cases, like if I look at the paper by Budish, Crampton and Shim, we have also arbitrage promise due to symmetric information, information. Like the interesting point is that while in this paper, like this is due to continuous time serial processing market, in this case, we have a discrete market by design, because like the MM is built on discrete time trading, and we don't worry about speed. We cannot solve the problem within speed. We can only solve the problem by better design the pricing function of the MM. So this basically leads me to the key and final result, which is the fundamental trade-off that we see here is between the fee revenues from trading versus the arbitrage rent. So what happens is that if the size of the shock is large enough, then there is basically a lot of incentive for arbitrageurs to exploit this arbitrage opportunity. And as a result, the liquidity provider may stop depositing in the first place. So the amount of token that they deposit is zero for all liquidity providers, exactly because like it's not longer incentive for them, the fee that they would get from the investors are outweighed by the losses that they get from being exploited from the arbitrage. And because of that, we also see that if like the size of the shock is large, so there are a lot of opportunities for arbitrageurs to exploit, or there are a lot of tokens in the AMM, we see also that both the expected value and the variance of the execution fee goes up, which basically means that there are externalities on other users because they are all sharing the same platform and they will have to pay larger fee if they want to get executed. So there are some empirical implications, but I will stop here because we don't have time. So bottom line is that we have identified like the problem, which is the arbitrage rent created by the design of the MM. And the consequences are like increasing cost of liquidity provision and limited adoption, because we can see that we can have a liquidity freeze, especially for unstable pairs where there is a lot of volatility. And in the paper, we show that if you want to mitigate the severity of the arbitrage problem, then you have to design properly the pricing function. And there is an optimal pricing function that can be designed. Thank you.
Thank you very much. We have a very brief amount of time if there are questions for any of the three speakers. And hearing none, I think we will now proceed to a brief 10-minute break and then reconvene at 1:55 for the panel discussion. So thank you to all three presenters.